The cryptocurrency market has experienced significant turbulence this week, driven primarily by the U.S. government's announcement of sweeping new tariffs. As President Donald Trump's administration pushes forward with these levies, investors are grappling with the implications for both traditional and digital asset markets. Early trading on April 3 saw a notable decline in U.S. cryptocurrency stocks, with Bitcoin falling by 2.3% and Ether by 3.3% as apprehensive investors moved to sell off riskier assets. The tariffs introduced on April 2 are extensive and vary by country, with duties on imports from China set at 34%, the European Union at 20%, and India at 26%, among others. The White House's strategy aims to recalibrate trade relations and bolster the U.S. industrial base. However, analysts warn that the impacts of these tariffs extend beyond traditional sectors, affecting cryptocurrency markets as well. The price action highlights crypto's hyperdemocratic and borderless nature, allowing investors worldwide to hedge against the potential impact of macroeconomic uncertainties, noted David Hernandez, a crypto investment specialist at 21 Shares. The relationship between tariffs and the broader economic environment is becoming increasingly complex. As companies reassess their supply chains in light of the new tariffs, the potential for compliance issues rises. PYMNTS has reported that the intricate interplay between tariffs and Know Your Business (KYB) compliance is crucial, particularly for financial institutions and multinational corporations. The pressure to manage costs without falling foul of regulations could lead to an uptick in fraudulent practices such as misclassification of goods or undervaluation. Robust KYB protocols are instrumental in helping to detect these schemes and safeguard corporate compliance and reputation, the report emphasized. Investors in cryptocurrency ETFs may find opportunities in this turbulent environment, although Marco Iacchini, Senior Vice President of Research at Vanda Research, cautioned that the size of this inflow could dwindle under shaky market conditions. The uncertainty surrounding the tariffs is prompting a cautious approach among many investors, steering them away from high-risk assets. In addition to cryptocurrencies, the automotive sector is bracing for significant price hikes due to the new tariffs. With a 25% duty now in place for cars assembled outside the U.S., analysts predict new vehicles could see price increases of $10,000 to $20,000. This will not only affect new car prices but also lead to increased costs for used cars as demand shifts due to the rising prices of newer models. Michael Holmes, co-CEO of Virginia Tire and Auto, expressed concerns about the long-term sustainability of absorbing these costs, indicating that businesses would likely have to pass them on to consumers eventually. As the U.S. economy adjusts to these new tariffs, the immediate effects on consumer purchasing power and spending could lead to a broader economic slowdown, with estimates suggesting a potential reduction in economic output by 0.2 percentage points. The administration's rationale for these tariffs rests on the belief that they will encourage domestic production and reduce reliance on foreign imports. However, experts like Nicole Hammond from Angel Oak Capital warn that re-establishing supply chains in the U.S. is a complex task that could take years if it happens at all. As the cryptocurrency market navigates these new challenges, the broader implications of the tariffs will continue to unfold. The interplay between economic policy, market dynamics, and investor sentiment will be critical in shaping the future of both cryptocurrencies and traditional markets alike. Investors and businesses alike are left to ponder how these changes will affect their strategies moving forward in an increasingly interconnected and uncertain global economy. In a whirlwind day for financial markets, Bitcoin has seen a significant downturn, dropping to approximately $81,000 as the implications of former President Donald Trump's newly announced tariffs reverberate through the economy. The cryptocurrency, often viewed as a barometer for risk appetite among investors, fell by nearly 4% following the announcement, mirroring a broader sell-off across various asset classes. The tariffs, which impose a minimum of 10% on a range of goods from select countries, have sparked renewed fears of a global trade war, causing a ripple effect in the stock market. The S&P 500 is on track for its worst trading day since September 2022. with shares of major crypto-related companies like Coinbase and MicroStrategy plummeting over 7%. Bitcoin moves at the intersection of narrative liquidity and leverage. Right now it's mostly trading like a high-beta macro asset, noted Ben Corlin, CEO of crypto research platform DYR. He emphasized that current market dynamics are less about the fundamentals of cryptocurrency and more about broader economic signals. Bitcoin has fluctuated within the $80,000 to $90,000 range for much of the past month, largely influenced by movements in the equities market rather than any specific developments within the crypto sector. David Hernandez, a crypto investment specialist at 21 Shares, pointed out that despite the recent volatility, Bitcoin has maintained support levels that indicate robust underlying demand. Markets thrive on certainty, and with speculation now largely removed, institutional investors may see an opportunity to take advantage of compressed valuations. He stated, "The market's reaction to the tariffs highlights Bitcoin's sensitivity to macroeconomic policy changes." Charles Edwards, founder of Capriole Investments, explained these tariffs are coming in higher than expected and are shaking investor confidence. He referenced the Philadelphia Fed's Business Outlook survey, which has slipped below critical thresholds, historically signifying impending economic downturns. Technical analysis suggests that Bitcoin is at a crossroads, with $91,000 acting as a crucial resistance level. Edwards warns that if Bitcoin fails to reclaim this price, it could face further declines, potentially testing the $71,000 support zone. While no guarantee of the future outlook, this reading is something we have had before at very high risk zones, he cautioned. Despite the bearish sentiment, there are signs that rising global liquidity could provide a lifeline for Bitcoin. Analysts have noted an anticipated influx of M2 money supply, which historically has correlated with price surges in Bitcoin. Speculation surrounding the U.S. Federal Reserve's potential return to quantitative easing adds another layer of complexity to the situation. How long until the Powell printer starts humming? Edwards asked, alluding to the possibility that easing monetary policy could ultimately benefit Bitcoin. As the market braces for what may come next, Bitcoin traders are advised to keep a close watch on upcoming economic developments, particularly related to trade tariffs and Federal Reserve policies. The next few weeks will be crucial for Bitcoin's trajectory, either confirming its resilience or exposing it to deeper vulnerabilities. With uncertainty at its peak, the cryptocurrency landscape remains fraught with volatility, leaving both investors and analysts pondering the future of Bitcoin in an increasingly unpredictable environment. In a turbulent day for financial markets, Bitcoin has seen a significant downturn, dropping to approximately $81,000 as President Donald Trump's announcement of sweeping tariffs sent ripples across the economic landscape. The cryptocurrency, which has fluctuated between $80,000 and $90,000 in recent weeks, faced an immediate impact as investors reacted to the news of tariffs that could escalate into a broader global trade conflict. On Thursday, Bitcoin fell more than 4% to around $82,413, while other major cryptocurrencies like Ether and Solana experienced steeper declines of 7% and 13% respectively. The announcement has contributed to a broader slump in risk assets, with the S&P 500 index poised for its worst day since September 2022. Shares of prominent crypto-related stocks, including Coinbase and MicroStrategy, both plunged by more than 7%. This sharp response underscores the sensitivity of cryptocurrency markets to macroeconomic developments, especially those involving trade and fiscal policy. Bitcoin moves at the intersection of narrative liquidity and leverage, noted Ben Corlin, CEO of the crypto research platform DYR. Right now, it's mostly trading like a high beta macro asset, tracking real yields, rate expectations, and dollar strength. Corlin's observations highlight how Bitcoin is increasingly influenced by traditional financial indicators rather than its inherent qualities as a decentralized digital asset. The tariffs, which include a 10% levy on a broad range of imports from various countries including China and the European Union, have heightened fears of escalating trade tensions. China faces the steepest tariffs at 34%, while the EU and Japan are subject to 20% and 24% tariffs respectively. Investors are concerned that such measures could lead to retaliatory actions, further destabilizing global markets. Despite the downturn, some analysts see potential resilience in the cryptocurrency market. David Hernandez, a crypto investment specialist at 21 Shares, indicated that Bitcoin's ability to hold above critical support levels could signal strong underlying demand, although the tariff rates were slightly higher than expectations. The announcement provided much-needed clarity on the scope and scale of the policy, he explained, suggesting that institutional investors might view the situation as an opportunity to capitalize on lower valuations. Historically, cryptocurrencies have tended to perform poorly during periods of heightened uncertainty. John Wu, president of Ava Labs, remarked that, as a risk-on asset, cryptocurrencies have generally traded poorly during periods of uncertainty following announcements such as steady high rates or the introduction of trade tariffs. This pattern appears to be repeating itself as market participants reassess their exposure to digital assets in light of potential economic disruptions. As the dust settles, the focus will likely shift to how these tariffs will affect broader economic conditions, including inflation and interest rates, which are critical factors for both stock and cryptocurrency markets. Investors and analysts alike will be closely monitoring the evolving trade landscape and its implications for asset performance. In conclusion, the recent tariff announcement has triggered a wave of volatility in cryptocurrency markets, with Bitcoin and other digital assets feeling the brunt of investor anxiety. As traders navigate this uncertain terrain, the coming weeks could reveal whether Bitcoin can reclaim its footing or if further declines are on the horizon. With the global economy facing headwinds, the interplay between traditional markets and cryptocurrencies will remain a critical area of focus for investors as they seek to make informed decisions in a rapidly changing financial landscape. In the fast-evolving landscape of cryptocurrency, competition among leading platforms has intensified, particularly between Ethereum ETH and emerging contenders like Solana SOL. Recent analyses suggest that Solana may have the potential to outperform Ethereum over the coming years, primarily due to its superior scalability and lower transaction costs. On April 3, 2025, a piece from Nasdaq highlighted a critical advantage for Solana: its ability to handle a significantly higher number of transactions per second compared to Ethereum. This scalability has become increasingly relevant as the demand for decentralized applications (dApps) surges. Solana's architecture allows it to process thousands of transactions per second with minimal fees, making it an attractive option for developers and users alike, noted a Nasdaq analyst. In contrast, Ethereum has faced ongoing challenges with high gas fees and network congestion, particularly during periods of increased activity. As the cryptocurrency market grapples with volatility, Ethereum is not just contending with Solana but also facing challenges from established players like XRP. A recent analysis from Bitcoinist.com argued that Ethereum has the potential to outperform XRP, largely due to its extensive ecosystem and the ongoing transition to Ethereum 2.0, which aims to enhance its scalability and energy efficiency. Ethereum's shift to a proof-of-stake model could significantly bolster its long-term viability, the report stated, emphasizing that this transition may attract more developers to its platform. However, Ethereum's current market performance has raised concerns among some analysts. A report from the Daily Hodl cited trader Ali Martinez, who warned of a bearish pattern emerging in the ETH/BTC trading pair. Martinez suggested that if the current trend continues, Ethereum could see a drastic decline against Bitcoin, potentially plummeting by 91%. The ETH/BTC trading pair appears to be forming a double-top pattern, which is typically a bearish reversal signal, he explained. This bearish sentiment is compounded by recent data indicating a significant drop in whale activity on the Ethereum network, as large holders sold off over 760,000 ETH in just 2 weeks. The broader implications of these developments are profound. If Ethereum fails to address its scalability issues and lacks the support of its whale investors, it risks losing market share to more efficient platforms like Solana. Meanwhile, Bitcoin's recent performance has also been scrutinized, with Martinez cautioning that it is approaching critical resistance levels that could indicate further bearish trends if not overcome. Bitcoin needs to break above its 200-day and 50-day moving averages to regain bullish momentum, he noted. As Ethereum navigates these turbulent waters, it must leverage its ongoing upgrades and vast ecosystem to maintain its competitive edge. The ongoing innovations in the cryptocurrency space suggest that the race is far from over. Observers will be keenly watching how Ethereum responds to these challenges and whether Solana can indeed capitalize on its advantages in the years ahead. With the cryptocurrency market remaining highly volatile and ever-changing, the next few months could prove pivotal for both Ethereum and Solana, shaping the future of decentralized finance and beyond. In the ever-evolving landscape of cryptocurrency, recent developments suggest that Solana SOL may have the potential to outperform Ethereum ETH in the coming years. With significant institutional interest and an expanding ecosystem, Solana is positioning itself as a formidable contender in the realm of decentralized finance, DeFi, and beyond. This insight follows a series of market analyses that highlight the reasons for this potential shift, particularly in light of recent survey data and strategic moves by major players in the industry. One of the key drivers behind Solana's promising outlook is the increasing interest from institutional investors. A recent survey conducted by Coinbase Global revealed that a remarkable 73% of institutional investors hold digital assets beyond Bitcoin, BTC, and Ethereum, with Solana and XRP emerging as the most popular altcoins, held by 30% and 34% of respondents respectively. This data underscores the growing traction that these coins are gaining among investors with substantial capital. As Alex Carchidi of The Motley Fool notes, the influx of institutional investment could lead to a significant upward pressure on prices, particularly as these investors begin to explore the DeFi sector. Moreover, the survey indicated that 51% of those polled do not currently engage with DeFi protocols but plan to do so within the next 2 years. This trend is crucial, as it aligns with the fundamental strengths of both Solana and XRP, namely their ability to facilitate fast and cost-effective transactions. As institutional capital begins to flow into DeFi, it is likely that these investors will favor platforms that offer the best user experience and efficiency, positioning Solana favorably against Ethereum, which has been criticized for its transaction costs and speed. Additionally, the recent announcement by PayPal to support Solana and Chainlink Link further bolsters the case for Solana's growth. By integrating these cryptocurrencies into its payment ecosystem, PayPal not only lends credibility to Solana but also opens up new avenues for adoption among its vast user base. This strategic move highlights the increasing mainstream acceptance of cryptocurrencies and could lead to further price appreciation as more users engage with these digital assets. However, it is essential to approach these developments with caution. While institutional interest may reduce some inherent risks associated with investing in Solana and XRP, it does not eliminate the volatility that is characteristic of cryptocurrencies. As Carchidi suggests, potential investors should carefully consider their financial situations and risk tolerance before allocating significant portions of their portfolios to these assets. Looking ahead, the trajectory of Solana and XRP will largely depend on how successfully they capitalize on the growing DeFi market and the ongoing interest from institutional investors. As the cryptocurrency ecosystem continues to mature, Solana's ability to maintain its competitive edge will be crucial. With institutional capital increasingly flowing into DeFi, both Solana and XRP may well find themselves at the forefront of a new wave of digital finance, potentially reshaping the landscape of cryptocurrencies for years to come.